gonna go.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
All right, welcome to the COB. I'm Juliette Sarli. This Thursday, as we once again see weakness coming through on the market, the ASX 200 just holding above 8,100 points. You can see the CBO 200 is off the lows of the session, down though by around 1/3% today. A lot going on as we continue to, of course, monitor what has been occurring with the latest in terms of tariff, tit-for-tat tariff trade wars, I guess. And you've also got this oil price hitting a 3-year low. I should point out that Star, which we've been following for some time, does look like it's on the brink of a rescue deal, and that's coming through according to the APRA from a new deal with Hong Kong investors. But let's get to the themes of the day, and we talked, of course, about oil tanking. That 3-year low really dragging down the overall energy sector, not helping out by the fact that Woodside was ex-div today as well. We're also closely on Cyclone watch as, of course, Alfred bears down, and of course our thoughts with anyone in the path of Alfred. We've been watching very closely what's happening with the likes of Johns Lyng Group, which was the stock of the day today, and of course the insurers as well. And Aussie we've got there, because the Aussie dollar, of course, has come back quite significantly from where we saw it in January, but it's actually having its best week in around 2 years. So a little bit more of an upside, although of course we've been talking through as well what a potentially weaker Aussie dollar means in terms of this tariff war. But 63.4, so up 1% overnight, up more than 2.1% this week, and that means the best weekly gain we've seen since 2023, all due to that broad decline that you're seeing in the US dollar index. Let's get into some of the sectors of the day as well. Having a look at those insurers as Alfred bears down. IAG did come through with an update on its exposure, up by around 1/3%. QBE and Suncorp both weaker today. Having a look at the banks, in kicking it off with CBA really weighing on the overall index, down 1%. ANZ and NAB though looking pretty resilient, and then of course looking at the energy space as we continue to see that weakness in crude oil, and as I mentioned, Woodside ex-dividend today, so sending its shares below $23, which, and this is not financial advice, I'm just repeating what I heard on the call yesterday. Andrew Valent from DP Wealth Advisory told me he thinks it looks like a buy when it got below 23, which it looks like it has today. Elsewhere, Myer jumping after Morgan Stanley declared it sees a pathway for the retailer shares to double under the company's new leadership and strategy. Shares up almost 6%. Amcor under pressure, this after it unveiled plans to reorganise its business. Air New Zealand also in focus today. Now, Chief Executive Greg Foran will leave the airline in October following a 5-year stint as CEO. And Mesoblast coming under pressure on its first day of trading in the top 200, down by some 8% at one point. Meanwhile, West African Resources was higher after its profit and gold sales soared in 2024. All right, let's welcome now to the COB, Martin Lakos from Macquarie Bank. Good to see you, Martin.
Afternoon.
So finally, reporting season behind us.
Yeah.
March off to a great start.
No.
Talk us through your views.
Well, I guess starting on the reporting season, you looked pretty good for the first 3 weeks, and then unfortunately we saw quite a lot of results, particularly in the small cap space in the mining sector, dragged back the data of the statistics on how well the reporting season was panning out. Overall, still a modest gain in terms of the number of upgrades to downgrades, but could have been better. Yeah. I guess to some extent it's also reflective on the softer economy, and I guess to some extent a lot of the uncertainty that's going on from a global perspective. Post-reporting season, we certainly saw, or through the reporting season, we certainly saw more defensive sectors performing better, so the likes of infrastructure, for example, and the resources sector underperforming. But today, we've seen a reverse of that, haven't we? Almost a rotation where those defensive sectors doing not as well. Miners doing it particularly better. I noticed South 32 had a better day today on an upgrade by an investment house. And that's despite going ex-dividend as well. So that's done pretty well. And also some of the retail stocks, not only just Myer on the back of that commentary, but REA is up strongly today. So some of those household exposed sectors are doing better today as well. The overarching question though has to be, we've seen some volatility, and is it going to continue? And the answer is absolutely. While we're seeing what's going on around the world, particularly from the United States and the Trump administration, there continues to be a lot of uncertainty, unpredictability, and that's having an impact where we're seeing the US market's up 300, down 600, so we are expecting that to continue. At some stage it'll start to subside and hopefully smooth out, but we just don't see that there just yet.
So what's the strategy then? Do you just pick the days when some of these stocks get really hammered and that's an opportunity to move in, or what is your strategy amidst the uncertainty?
Well, certainly from a broader asset allocation perspective, so we're talking about holistically looking at all assets across international and domestic, we continue to favour the alternative asset classes, so such as the private equity side by active fund managers, the infrastructure, real assets, their longer duration investment timeframes, and so that sort of gets us past this shorter term volatility that we may see it. Equally so, although President Trump has been talking down the American economy has actually been doing pretty well. He's inherited an economy that's in reasonable shape. Now, does the tariffs have a negative impact on that going forward? Are we starting to see some softness in the household sector in the US? Yes, we are. Are there some limitations on what the US Federal Reserve can do going forward if there's going to be higher costs like tariffs coming to the economy that are inflationary, but are offset by lower taxes and lower energy prices? So there's so much in the mix for investors to be taking into account. And when we see these sorts of activity taking place with no clear trend, it's sometimes just better to sit on the sidelines for a little while and see if that's starting to settle down. And that's certainly our view. So from investing in growth, we are thinking more and more of sitting on the sidelines. We've already seen the NASDAQ down, 6 or 7%? It doesn't really feel like it, but it has from its highs. Equally so, we've seen 2.5% off our market in the last or the last week or so.
Yeah. So
overall, we're seeing a little bit of a correction phase. We don't see a massive correction, so we're looking for the turning point. We're looking for where we can start having a bit more confidence about buying into growth, but we're not just there yet.
All right, I just wanted to go back a little bit to what you talked on about with the retailers and Myer, of course, that very bullish call from Morgan Stanley today, and that's really about the new leadership too. But when you look at the GDP print that came through, the fact that retail sales was higher, the fact that we've had one rate cut since that GDP print, is there going to be more upside for some of these consumer players?
Well, I wouldn't be reading too much into the GDP numbers. It's a one set of better data, but we want to see that to continue. Having said that, we made a call that we do believe the Aussie economy has probably bottomed in that fourth quarter, and that's maybe reflective on that GDP data, but we want to see a lot more to come through before we're totally convinced. And of course, the overriding factor still remains inflation in Australia. And that's going to drive what the central bank does here, the Reserve Bank. So we are continuing to believe that the Reserve Bank will cut in May and again in August. So 3 cuts this year is our limitation of where we see the Reserve Bank moving. And there's probably very little in that GDP numbers that would suggest that the economy's taking off and the Reserve Bank would actually have a longer pause on cuts. So we still think that's intact, but we are looking for a slightly better economy. The retail sales numbers are welcome, but again, when you look at things like credit card spend, it's not coming through universally. There's absolutely no doubt there's been a slight pickup in consumer staples, and again, very specifically, some pickup in discretionary spend, but it's not broad brushed. So again, we're not waving the white flag just yet saying it's all over.
Okay, speaking of waving the white flag, I mean, when we get these headlines coming through from the White House, almost minute by minute.
Yes.
How does that sort of change your overall allocation? We have seen a Trump presidency, I should say, before, but it seems like, we're still getting a lot of whiplash here.
Yeah, and whiplash is a great word. And look, from one day to the next, there's a change in the rhetoric around tariffs against Canada and Mexico, and maybe they're going to be halved, maybe they're going to be delayed. And while we have this sort of whiplash that's taking place, I think to some extent that absolutely backs the view just to be extra cautious in the markets at the moment. But there will be a buying point at some stage down the track, but we need to see all of this start to settle down. So that unpredictability is a key factor for us. And to some extent, when you look at what's going on, the potential of, although they're looking to cut bureaucracy and government spending, the current policies as articulated through the election campaign would add $4.1 trillion to the US budget deficit. So that's to some extent inflationary in itself, along with tariffs. So again, it starts talking about the implication of what the central bank would do in the US. Having said that, we've actually seen a really strong rally in US bond markets. So the 2-year bond yield is down to 4.1%. It wasn't that long ago, it was nearly 4.6. The 10-year bond yield is now 4.25. So there's a rally taking place in bond pricing and lower yields.
Yeah.
And that's saying there's some money being moved to more defensive and basically safe haven, given this volatility. And again, that gives us a sense that that's probably the right move to be considering just at this point in time.
Well, speaking of massive moves in bonds as well, and then the ECB tipped to cut again.
Yeah.
What are we reading into the volatility there?
Well, the European Central Bank has to keep cutting because the European economy effectively went through a recession, albeit very shallow, and 2 quarters of negative growth. German industrial production, manufacturing continues is negative, and Germany is about 40% of the EU total activity. So it's very important to see a pickup there. So no wonder the ECB is looking to help and try and stimulate the broader European economy. Italy's probably doing the best or better than most in under these circumstances, and France is very, very mixed. So they need to see some recovery taking place. There's no doubt about that. So we would have an expectation for that to start to improve. But there's a pretty close tie also between Germany and China.
Yeah.
Germany does a lot of exports of technology and capital goods into China, and the Chinese economy we know has been weakish or certainly tepid in terms of its recovery, given the stimulatory action that's taken place so far. So if we're going to see more stimulatory action, which we believe the authorities will undertake, and some commentary yesterday at the Congress would certainly suggest that's the case, then the implication is that maybe things will start turning up for Germany as well.
Yeah.
But we're a little way off from that. So understandably, there's more stimulatory action to take place by the central bank in Europe.
And as you said, from China too, very interesting. They've still got that 5% growth target, Martin, that they named at the NPC. Always good to see you, Martin Lakos from Macquarie Bank, with me here. All right, moving to the stock of the day, of course, we touched on Johns Lyng Group. Howard Coleman from Team Invest and Kai Chen from MPC Markets joined Andrew.
They're not actually an insurer. They're a building company or a whole lot of I'm calling them franchises, they're not legally franchises, but a whole lot of different operations that are affiliated with them and work under them, whose job it is to repair the damage caused when somebody's home or property gets damaged. So they're not paying for this, the insurance companies are paying for it, and they called in to assess it, have a look, say how they could repair it and repair it on behalf of the insurance company.
The amount of work for John Lyng has gone down for that catastrophe business segment. But as we saw in LA and potentially in Brisbane and the North Coast, there might be a bit of damage done, yet to be seen. I think it makes landfall tomorrow, so we'll probably have a look at that tomorrow. In terms of investment thesis, I think it's absolutely cheap. And that earnings move where it dropped about 30%, I think was very exaggerated for what they reported. So I think at the moment it's a bit undervalued, and it's definitely a decent buy.
All right, let's have a look at the market leaders. Today, West African Resources came through with a pretty good update, sending its share price higher. Bellevue Gold also looking good. Johns Lyng, we just went through on the call there, up 6.5%, and also, seeing a lot of moves in these defensive players like healthcare. Cochlear was up by more than 4%. To the downside today, Smart Group, we spoke, of course, to them coming through after their earnings. And a lot of brokers sort of cutting their forecasts for Smart Group. It was down 5%. Woodside Energy traded ex-div today. ResMed under pressure. AGL was off by 3.4%. And Levies, another stock trading ex-div, down 3.6%. In the small end of town, SmartPay is there, up 16%. AI Media Technology, that's another one that's been on a tear, up by 11.5% to 73 cents. To the downside today, in the small end of town, are these stocks on your screen, including Appen, which was an interesting one that NabTrade said was one that they're seeing a lot of activity in. It was down 10% today, $1.31. Tonight, the Euro Summit, obviously the ECB monetary policy statement, and of course another cut expected, trade balance and US challenger job cuts. And then tomorrow, of course Friday, not a lot ever really in terms of economic data, but still going heavy with these ex-div stocks, including Endeavour and a number of other companies that will trade ex-dividend tomorrow as well. All right, let's check out where we are on the market as we round out the day's trade. Off by around 1/3%. The ASX 200 down about 46 points, 0.5%, 8,094. So a new 20-day low there. We touched on Smart Group and Woodside being among the laggards. And when it comes to sectoral moves, really this drop in energy prices weighing quite heavily on the energy sector, which is down 3%. There was a nice pickup, and Martin alluded to that in some of the mining players today. In particular, he was calling out South 32, IT and REIT stocks also looking okay today. Right, that does it for this edition of the COB. We'll be back bright and early tomorrow from 9:45 a.m. Eastern. We'll see you then.